Hello, test, test. Okay, welcome clients to our weekly market call. Thank you for attending in this very close to holiday season. And I'm Joshua, the head of research. I'll give you a briefing on the macro outlook, and then Kenneth will talk about market analysis. And Yongkai will be talking about Intercontinental Hotels, which is a US stock. Okay, our macro asset allocation strategy has been overweight stocks and neutral to underweight bonds for quite a long time. And this stance has not changed, and we're not changing that stance. And actually, now that QE is underway, finally, I think this stance will be even more reinforced. Now, the Fed has reduced monthly bond buying from 85 billion a month to 75 billion, and guidance is that it could reduce QE at each meeting going forward, subject to economic data. Now, the investment community has speculated that if we continue this 10 billion reduction rate and the way economic data is going, we really could be done with QE by the end of 2014. That means by the end of 2014, there'll be no more bond buying, and that would be the end of that. So the Fed took quite great pains to give a stronger forward guidance in view of its QE withdrawal. And that was to keep the Fed funds rate near zero, now well past the time that the unemployment rate goes below 6.5. So previously it was that once the unemployment rate goes below 6.5, then they would start to increase the Fed funds rate. But now they say they'll keep it below near zero well past the time. Okay, it's kind of like a give and take situation, since it's withdrawing QE, that it would give stronger forward guidance for the Fed funds rate. Now this forward guidance is also subject to the rate of inflation keeping below 2%. So equity markets have reacted well, as the Fed took great pains to communicate that this tapering was precisely because the economy is much improved. We have been guiding this for a while, that the end of QE is not going to be the end of stocks. In fact, I think it'll be the ignition of a new move higher, because we expect portfolios to continue rotating out of bonds into stocks. And so we maintain that the bull run is not over yet, despite a sideways year for Asia. Given this environment of an improving global economy and rising interest rates, we favor banks. Our top pick will be DBS. We favor industrials, and our top picks are Keppel Corp and Bausted. Cyclicals also will benefit, especially consumer discretionary, and for that we have initiated coverage on Intercontinental Hotels. We have coverage already on Iconics Brands and Amara, which are consumer discretionaries. Okay, I'll move you on to Kenneth now for market analysis.
Morning all. Okay, all right, let's continue with the market analysis. So our stance on gold has been the same for this week as last week. We mentioned from last week that gold was the bearish longer term, and short term it was at support but bearish. So last week we note that there was a slight rebound, which we expected a bounce, and a bounce occurred, and then the price essentially went higher and got rejected by this bottom resistance here, this line here, and so last week I mentioned that I did expect downside since the bounce already occurred and the price was already rejected. So this week, price continues bearishness this way. Okay, yes, I agree that the RSI is still oversold, but that's probably not a reason to get into gold, okay, because we are longer term bearish because of fundamental reasons. And we wouldn't consider going long unless this resistance is taken out. Okay, so unless this resistance is taken out, right, we should not go bullish on gold. Even at these levels here, we note that the gold miners' relative performance is still going down. Okay, so I don't really see at this point market, I'll say conviction or strength at this point here to go bullish. Okay, now if this particular level here is the last major support, if that gets broken and we're on the way to doing that, that actually implies a move to 1000. Okay, so we have to note to see whether this 1200 level is taken out. Okay, S&P 500. We noted last week that I gave a case that the last 2 weeks of the year would probably be bullish, and that's what we got. So from tapering news, which is on this candle here, we saw that price initially got sold down and quickly reversed on the upside, and this increases the probability of the Santa Claus rally that I talked about. And so predictably, it has gone higher, but it cannot break through the upper channel support. Okay, this is the multi-year upper channel support. Okay, so considering that breadth has actually improved somewhat, and the Russell to S&P ratio has actually started to improve, okay, this increases the probability that I believe that price will simply just creep along this channel here, okay, towards the end of the year. Okay, so I expect a gradual upside for the S&P, okay, until the end of the year. Just to recap from last week, that December is statistically, historically, a month of outperformance compared to most other months. Okay, and so is the Russell. As you can see, the small caps usually get a big bid in December as well, and that also increases the probability of the Santa Claus rally, which I talked about. Okay, we did talk about the first 2 weeks of December usually is soft because of tax-related selling in the US. Okay, now for the STI, we did note 3 weeks ago that 3050 was the support level. Okay, and we've actually hit that level, rejected off of it, and we are negotiating off the support right now. Okay, so at this point, a bounce seems very likely. Okay, but of course, if the support 3,550 is taken out, then this is quite a big support. We would have to reconsider our thesis. But based on what we see in the US market, and the Singapore market is somewhat correlated to the US market, we believe a short bounce is in order towards the end of the year. Okay, so Singapore, just like the Russell, also has December as its outperformance month statistically. Doesn't mean this month will follow suit, but the odds are in your favor. Okay, for China, we noted that there was a breakout, what seemed to be a breakout, and we guided that we have to make sure that the price doesn't fall back into this channel before we claim that it's a real breakout. Okay, I did say that this level here is a major resistance, okay, and it was not taken out. So because of interest rate reasons, okay, it seems that price has fallen back here, and now we are essentially a bit oversold right now. So technically speaking, I just speak technically at this point, okay, we would like to see price break out of this multi-year downtrend line before we can say it's a breakout. Okay, now if price does not do that, then it's going to be very likely that price will drop back down to the 2000 level. Okay. Yep. But at the moment, we are short-term oversold. Would not surprise me for this week if price just paused at this level before deciding what to do next. Okay, and that's it for the market analysis for this week. And I'm going to pass you to our US analyst, Yong Kai, who will talk to us about Intercontinental hotels.
Hi. Hi, this is Yong Kai, the US analyst here. Okay, so today I'll be talking about Intercontinental Hotels. This is a US company listed on the New York Stock Exchange. It's the largest hotel group by room counts with nearly 680,000 rooms in the world. Okay, so snapshots, the share price is $32 at a 52-week high. Market cap is $8 billion and dividend yield, including the special dividends given out this year, 6.2%. So some quick background, by room count is the biggest hotel group in the world. It franchises, manages, leases or owns 4,600 hotels and 680,000 rooms in nearly 100 countries. So its biggest brand, Holiday Inn and Holiday Inn Express, is the largest hotel chain as well. It's actually way ahead of the number 2 Best Western, which has 38% more rooms. Okay, so we have another 180,000 rooms in the pipeline, which is 26% increase from today. Half of it is in the emerging markets, Asia, Middle East, Africa, and Greater China. Okay, so what I want to bring to your attention is that franchising is one of the most lucrative of the hospitality value chains, right? Because it has very strong cash flows, it's recurring, high margins, and you don't really need much capital to like lend out your brand name, your operating procedures. So as a result, minimal capital for either you don't need any capital for construction, for ongoing maintenance, and minimal amount is required. Standard contract will stipulate around 5% of room revenues for your franchise royalty fees. So for IHG, it actually has 99.4% of franchise hotels, one of the highest among peers. On top of this, the owners are required to contribute additional room revenue to support marketing, to support your loyalty programs, etc. So this totaled $1.1 billion last year. Okay, but because this doesn't flow through ISG, the profit and loss, the income statement, so you don't really see it. And we think that actually this is a very substantial amount compared to the $1.8 billion revenue this year. So it's actually, they have more than $1 billion that can go towards building up the brand value, recognition, awareness, but yet you don't see anywhere in the financials. Overall, the RevPAR has recognized healthy growth, 5 to 6% in the last 3 years. Okay, a bit on the financials, 22% net margins and 102% ROE. Why so high? Because it's mainly franchising, so it needs minimal capital and is constantly giving out special dividends. As a result, it's distributed around $850 million for the last year and this, which is equivalent to 10% of today's market cap. Okay, another thing is that the earliest debt maturity is in 2016, 3 years from now. All debts are unsecured, so it's actually in the process of selling down all its own hotels, and these divestment proceeds can be fully returned to shareholders. Okay, another point to note is that all 10 of its own in these hotels are classified as PPE and carry a historical cost, so they are most likely to be undervalued. We think that possibly it will be worth $10.1 billion, 21% upside from today. Okay, before we move on, we just want to reiterate that this is IHG Hotels. This presentation is non-rated, so we're not going to give any recommendation or target price. Yeah, but we do think that this is quite interesting at today's prices. So a quick primer on the industry. In the US alone, travel industry generated $1.4 trillion of economic output. Accommodation accounted for the biggest share of this, 19% of the sales. Leisure travel is a secular growth trend worldwide because of rising affluence, disposable income, increasing airline competition that drives down ticket prices, as well as more information available. Okay, in Singapore context alone, you look at the Changi Airport Group. So in the first 3 quarters this year, it actually has more passengers that pass through Changi Airports compared to the whole year of 2009. Okay, so on the other hand, business travel is increasingly redundant because of cost cutting, because of teleconferencing possibilities. Whereas at SIA, they also terminated their direct flights to New York from Singapore as well as to LA. Okay, one of the headwinds that there's competition from short-term rentals like Airbnb, VRBO, where the apartment owners rent out their apartments, so you don't need specialized lodging for this purpose. Okay, so this is a typical value chain. your hotel guests, you can either pay directly to the hotels or you go through the reservations. So we have like booking.com, we have hotels.com, Zuji, Skyscanner for example. So they'll take a booking fee and the rest will through the hotels. Then after the hotel, when your revenue, you have to first pay your hotel brand like franchisor. In this case, it could be anything from Holiday Inn, Crown Plaza, or Intercontinental, and then you pay the management fee. Yeah, this manager could be IHG as well, or it could be their own internal staff. And then you have your overheads, such as your staff costs, your F&B, your cost of your ongoing maintenance as well. So lastly, any leftover surplus or losses then goes to the owner. So the economics of franchising is a lot better than ownership. Okay. So you can see that for IHG, the total revenue from franchising is almost the same as the owned and leased hotels, but yet operating profits is more than 4 times higher because the operating margins are 84% versus your own hotels of 21%. Because essentially for franchising, you're lending out your brand name, your recognition, as well as operating procedures. As a brand owner itself, you don't require much capital. Yep. Whereas if you own it, you have to construct it, you have to buy over from someone else, and every 5 years you refurbish it. So it's very high capital requirement. Yep. So for franchise hotels, it'll be easier to grow and easier to scale up as well. Because for franchise hotels, they have lesser operating leverage, so they are less sensitive to a change in RevPAR. RevPAR is a metric that we'll discuss slightly in depth later. So, which means that if a 10% change in the revenue only impacts this IHG by 10%, whereas if you own hotels, you have to pay off all your financing costs, your management fees, etc. Any 10% change in RevPAR can affect your profits by 30%. So RevPAR, what does it mean? It means revenue per available room, the occupancy times the average daily rates. So what this means is that if your occupancy is 80% and then your average daily rate is $250, your RevPAR will be $200. That means on average, every room you're collecting $200 for the quarter or for the year. So this is an operating metric that adjusts for occupancy and room rates. So you can't just necessarily look at one of these metrics and then decide whether it's performing good or not. Generally, year-over-year growth in RevPAR is indicative of good performance. So we just quickly go through what are some of the merits. This number 1 worldwide ranking is 4,600 hotels, and by room count is the most in the world, above Hilton, Marriott, and any of the others. Okay, pipeline-wise, there's 180,000 hotel rooms in the pipeline, 26% increase from present day. So if I would just bring our attention to this percentage franchise, there's 99.4% franchise, and you realize that a lot of the other hotel groups also have more than 90%, because this asset-light strategy is favored by most hotel groups and requires minimal upfront capital, not ongoing capital expenditures. It's like recurring high-margin royalty fees. So historically, it's really sold off 192 owned hotels for $6.6 billion in the last 10 years. And now it's a means of selling off the last 10 hotels so they can focus more on franchising. You think about it, if you own hotels, it's actually competing with its prospective pool of clients, which are also hotel owners. So there's a conflict of interest. So a sub-brand that it owns, Holiday Inn and Holiday Inn Express, is the largest hotel brand in the world. It actually has now 38% more hotel rooms than Best Western, which is second ranking. And also it has more than double of that of Marriott hotels in the world. So it's actually ranked highest in guest satisfaction among mid-scale full-service hotel chains for 3rd year running. In terms of geography-wise, 68% of its operating profits comes from Americas, which includes North and South America, and 89% hotels are franchised or managed. Whereas for Asia, Middle East, and Africa, and Greater China, 88% hotels are managed instead. So half the hotels in the pipeline are located there, and unfortunately, managed hotels are harder to scale up because you require hiring and then you're deploying the IHG staff at each hotel. So that will slow down things a little. We compare against the industry, against the US lodging industry in particular, specifically. IHG America's RevPAR is consistently above the industry, but yet not too much higher. So it's actually just slightly mid-scale, performing above average, but not ultra luxury, other than the Intercontinental hotels. Overall, RevPAR is higher than America's, so abroad you're actually getting better RevPAR, better occupancy or rates. Overall, the RevPAR growth is 5 to 6% over the last 3 years, fueled by global recovery. Okay, so another way to look at it, right, is that what's the overall gross revenue of all the hotels that is franchises or managers or owns. So from 2009, $16.8 billion is increased to $21.2 billion this last year. So what this means that there's actually either more royalty fees or there's a greater scale for your own hotels and also contribution to the system fund. Again, this system fund is where hotel owners are required to contribute additional percentage room revenue to pay for marketing, your membership, etc. So they actually collected $1.1 billion last year, which was spent to improve brand awareness, to improve your hotel occupancy rates, and this is not reflected in IHG income statements. Margin is consistently at 20+%, 22% last year. ROE is 102%. The reason it fluctuates so much, despite increasing profits, is because that the capital base is relatively small. So every time where you have, like, say, your disposals, the first half of this year, there are $166 million gain on disposal. This increases the capital base and causes ROE to dip drastically. Even then, it's recording 102% ROE because it requires minimal capital. Profit growth seems to be weaker, but that's because of it's been selling its hotels over the past few years. So you look at 2009, it had 3,900 hotel rooms. Okay, sorry. Today it has 3,900 hotel rooms versus 5,008 in 2009. That's 32% fewer rooms. Yeah. I just want to highlight that the first half of this year is seasonally slightly weaker. So for the full of 2013, we're expecting net profits of roughly $430 million versus last year's of 407. Financials wise, you have two debt maturities in 2016 and 2022. It's unsecured, so that means that these are not collateralized by any hotels or real estate. And this also means that any divestment proceeds can be distributed directly back to shareholders either via special dividends or buybacks. So the total dividends have been up 58% since 3 years ago. I think it's pretty interesting that all 10 of the owned and leased hotels are mostly Intercontinental, of the higher luxury scale, upscale, and they're classified as PPE, carry a historical cost, so they are likely to be undervalued. IHG right now continues to divest hotels. Just first half this year, it divested a London hotel for $400 million and recorded a gain on disposal of $166 million. Similarly, it's put up for sale this New York Barclay Intercontinental Hotel, and we think that the sale value is easily higher than the net book value. Okay, because of this is the non-rated presentation, we refrain from giving a recommendation on target price, but by a back of envelope valuation, we see that the franchise and managed hotels, assuming that it carries all the overheads, that's even attributable to the owned hotels. So assuming that it carries all these overheads and all the interest expenses, then it will have contributed roughly $350 million net profits for this year, up 30% from 2010. So one way to regard this is that this income stream could be a perpetual fixed income instrument, yet high distribution growth. Currently, the dividend payout ratio is 33%, but it's been giving out more dividends than its earnings because of a lot of these disposal proceeds. So at 4% yield, this could be worth $8.8 billion. You add in the ongoing hotel divestment return of capital, and IHG today could be worth $10 billion, which is 21% upside from today's share price. Okay, so just to summarize what we have went through so far, IHG is the biggest hotel group by room counts, with 680,000 rooms in nearly 100 countries. It's Holiday Inn and Holiday Inn Express brands. It's also the largest hotel chain and has 38% more rooms than the second ranking Best Western. 26% more rooms are in the pipeline from present day, of which half are in the emerging markets. Franchising is a very lucrative and profitable income stream, strong cash flows, high margins, and low capital requirements. So of which IHG has like 99.4% hotels franchised. Owners are required to contribute additional room revenue as a percentage, which this year amounted to $1.1 billion that can improve your brand revenue, brand value, recognition, awareness, and this is nowhere to be found on the income statement or balance sheets. Overall RevPAR is healthy, 5 to 6% over the last 3 years. Margins are very respectable, 22% net margins. ROE is 102%. The total dividends are up 58% since 2009. Earlier set maturities in 3 years' time. Meanwhile, all the divestment proceeds can be fully returned to shareholders. Okay, so all 10 hotels are carrying historical costs and likely to be undervalued. So we think that today possibly worth $10 billion if you capitalize this income stream as at 4%. Okay, and also you include in the special dividends from hotel proceeds. Okay, one thing that we didn't really mention here is that right now when we talk about this $10 billion figure, we're using 4% yield and after-tax profits. So if IHG can convert into a trust in the US, and US there are listed hotel trusts that purely manages hotels and carry no assets. So if IHG can convert to such a trust, this tax transparency can increase his yield to 5.5% instead. Yeah, so there's additional upside that you might want to consider. Okay, so that's all we have for IHG, US listed company. And now open the floor to questions. Thank you. Uh-oh. Okay, I'll take the first one. Second one, I think. Okay, so the first question for today, we have a question on what's the tax implications for capital gain and dividends for investing in US listed companies. Okay, and or ETF that tracks the S&P Russell Index. Please share on capital gain tax, withholding tax, etc. Okay, I'm not too sure about the ETF, but I can tell you that for US listed companies, there is zero capital gain tax. Okay, I'm assuming that you are investing from your own personal account, and you are non-residents in the US. So there's zero capital gains tax for Singaporeans. Regarding dividends, there's a 30% withholding tax. Yep. Okay, the next question is, you want to understand the operation of hotel industry. Do you have any detailed reports on this sector? Okay, we'll forward you. Okay, maybe you can just provide us with your email address, and then we'll just liaise directly with you after this. Thanks. Okay, we have another question. What are the possible downside risks for IHG businesses? So IHG, again, its model is mainly franchising. If you talk about operating profits wise, it contributed, franchising and managing contributed 90% of the overall operating profits. So we think that downside risk is quite minimal. Of course, you might have another recession or you might have another SARS. The US hotel industry, okay, in general, the global hospitality industry was very badly affected from SARS, from like 911. So these are the black swan events that we really cannot foresee. Other than that, we think that actually IHG is pretty well situated because it, as a franchising model, it collects the first 5% of room revenues, and it doesn't have much. Doesn't have much, let's say, financing costs or assets or whatnot to pay off. Yeah. So we don't. And there's no clear-cut risk for the moment other than, let's say, a recession or, say, those Black Swan, 911, SARS, for example. Okay, and we have another question. What is the normal dividend rate of IHG excluding the special dividends? Okay, so IHG has been giving out its dividend payout ratio is roughly 33%. So right now its dividend yield excluding special dividends is roughly 2%. Note that the total dividends has increased 58% since 2010, and the interim dividend they have up 10% from the previous year. So there's still a lot of room for dividend improvement. Okay, another question is, notice that IHG's debt seems very high. Is there a concern? Okay, yes. If you think that, if you, from a normal accounting perspective, the debt over equity ratio will seem like, oh, you have maybe 2-3 times. But note that because of the business model itself, it doesn't require much capital to start off with. So there isn't any concern. In fact, this debt, they are not collateralized by any hotel assets. They are purely unsecured. Yeah. Okay, and now I would also maybe take attention to Marriott. Marriott is another well-known international brand. Okay, so Marriott actually has a negative equity. Why? Because it doesn't need any capital to support its franchising model. So I don't think that this debt will be any concern at all. And in any case, the earliest maturity is in 2016, so that's 3 years away from now.
Hi, we have questions regarding the target prices of the SGX stocks that were recommended at the start of the presentation. So DBS, we have a target price of 1750, but that is subject to change as we are currently reviewing the sector and we're pretty positive on the stock. Keppel's target price is 1225, which is a 13% upside from here. And Bastard's target price is $2.05, and that's a 25.8% upside from here. And yes, that's all. Thanks. Oh, sorry. Yes, Iconics brands. Can you yeah.
Iconics over here is $43, but on my previous earnings update, I revised it to 46.
46.
The previous earnings update.
Oh, okay. So the yes, Iconics brands, the target price is 46, which is as per our previous presentation. So that's more than 10% upside. Amara Hotels is 74 cents, which is 36% upside from here. Thanks. Oh yeah, we have another question on what's the difference between the Chinese A50 and the CSI 300. The A50 is very heavily weighted to banks and real estate, and so that's why we don't really recommend that index for a long-term play. The 83188.Hong Kong is the CSI 300, and that is tradable through Poems. It's because we do offer the Hong Kong market. And that index as well is a diversified 300 stocks on the Chinese A-share market. We have a very good question here on whether do we think that bonds will continue dropping as 2014 progresses. Actually, that is my feeling that yes, it will continue progressively fall. Because we have to remember that it's not cast in stone that that the Fed will reduce the bond purchases by 10 billion each month. It's subject to economic data. So I think as economic data, if we're correct and it continues to show that the economy is gaining strength, then we do believe that bonds will continue to fall.
Hi, we have another question on ISG, whether ISG has been paying special dividends for past 3 years. Okay, the past 3 years is actually global recovery, so it has been pretty much prudent, and it's taking a while longer to sell down its assets. But from 2004 to 2007, it actually returns $5.5 billion worth of capital in the form of special dividends and share buybacks. It's only resumed special dividends last year. It's really declared 2 special dividends worth about $850 million already. We have another question on ISG current price. This reader thinks that it's high, and whether do I not think that it's wise to go in now? Okay, this is a non-reader presentation, so we will refrain from saying that, oh, this is a trading buy, this is a trading sell. But from the track record of special dividends, from the way that it's disposing of its hotel assets and returning special capital, let me just say that again. From its track record of the past few years of returning additional capital, and it's a very sound business model of franchising, we think that this is a premium worth paying for. I mean, you think about it, franchising income has increased 30% in the last 3 years without any capital requirements. Yep, and the global hospital industry is looking stronger than ever.
There's a further question on the QE and bonds questions. Basically, the question is, should we wait for all the stimuli to be removed first, i.e. end of 2014, before you start buying bonds? I think if you're a trader, if you're trading bonds, then yeah, I mean, we would be short bonds all the way and not buying them. However, if you're talking about long-term asset allocation, then we would still think that 60-40 stock bond split has been proven over 30-40 years to be the best allocation if you're talking about really long-term holdings.
There's a question on tapering starting in 2014.
Okay, there's a question here on tapering again. So what's the immediate impact on the US and STI? We think that tapering is no longer a bearish thing for equity markets, given the way that markets have reacted to the news, and we think it's a positive for markets. However, the US does look very overbought, and I think for that we can't presume that although our view is that it's on an upward trajectory, it does look very stretched at the moment. The STI, on the other hand, is much less stretched. Would high-yield bonds adopt the same behavior as explained earlier by your side? Yes, it would. Yeah, actually, all bonds are looking bearish right now. Oh no. There's another question here. Is the STI too stretched? No. The STI is the one that is not stretched, right? The S&P looks stretched. However, we have to say that this QE tapering news is actually bullish for all stocks at the moment.
Alright, this is the end for our weekly market webinar. The presenting analyst today was Kenneth Koh and Wong Yong Kai. So, yeah, if there's any further question, you guys can connect them directly. Thank you.